Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. Today, we are talking about what do rent prices do? What do rents do during tough economic times? Because we talk a lot about, like we're building wealth. It's all about that growth thing. But, in tough economic times, I think there's a real lesson in how rents do. And I'm your host, Pablo Gonzalez. With me, as always, to present on this topic, did his studious homework, sent me a text at 12:30 last night.
I did.
Diving into the data as a first person to wish me happy birthday. I like to call him GC because he's got the genius concepts, which we're going to talk about today, because he knows how to generate cash flow, which is closely correlated to rents, because he's a great co-host. And because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
Thank you. I thought you were going to not finish there. And as always, we call her MTM because she brings us the moments that matter. She is our community manager and marketing associate in the chat, helping you out. Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And we are happy to be here today. GC. Podcast numbers are doing great. YouTube numbers are doing great. Community's doing awesome. Class has been doing great. You know what I'm pumped? I'm pumped about the video we're about to drop about the Gateway Jackson announcement. Yeah. It's going to be a really cool little thing. Look in the community. We're going to be dropping in there. If you are not part of our community, go to jwbfacebookgroup.com.
Mm-hmm.
You get to meet a lot of the people that are in the chat in here and be part of the community. And when you show up, you're live. You get to be part of what you see.
The roll call, baby.
We got our leadoff hitter starting off the day as is tradition.
John Henning,
of
course.
Henning in his rightful place. We got the MVP in the house.
Mr. Lee Bishop.
We got the ringmaster.
Drew Barnhill.
We got the early bird.
Mr. Dean Curry.
We got patron Santorius.
Michael Santorius.
From Virginia. Michael Santorius. Good to have you. I'm getting a lot of happy birthday love in here. I love you all.
There we go, buddy. Happy birthday.
Thank you
buddy.
for.
We
got the mountain.
Bill Green.
From the chill mountains of Colorado. It's been chill over here, too.
Yeah, it is.
It's getting chilly.
I know.
Chilly over here. Not the same amount of chill. We got Lita Song from Minnesota.
Great to see you, Lita.
A beautiful day. Thank you, Lita. Good to have you. We got the Shaw, man.
Nadeem Shah.
Nadeem Shah from the West Coast. We got our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
We got Leo Faraganan.
Dun, 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 dun,
Faraganan.
dun, 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 dun.
Good to have you back in the house. We got Pedro Nasanceno from
Jersey.
Good to have you. Marie Rockoff, good to have you back from Arizona as well. Sergio Prieto with
Go Gators.
Go Gators, that's right. Who else we got in here? Checking in our favorite name to pronounce, Aaron O'Neill.
Into the lights.
We got the first family, the matriarch and patriarch, Ken and Carolyn Moline.
We salute you.
We got Todd Johnson in the house. Todd, happy to have you.
Yeah.
Not the best.
We love that you're here, Todd.
I love that you're here. Not so much what you're saying.
Yeah, hard to accept.
Brian Manhara is in the chat, checking in with a happy birthday, Pablo. Thank you, Brian. Who else we got in here? We got Hervé Francois, our own with a what up? JWB fan with a happy birthday. He's
happy, not happy.
Thank you, Hervé. Good to have you. We got Big Game Gamison back in the house. Tamara Gamison.
That's wonderful. Good to see you, Tamara.
Good to see you. You can't just drop in here, give yourself a nickname, and then not come back.
That's true. That's true.
Come back to be called Big Game up in here. Bob Wiesner, my buddy. Good to have you, Bob. He says Georgia Bulldogs. All right, Bob. That's not us. That is.
We might have to cut off the chat here.
In opposites of a happy birthday greeting, just in case if that's what you're trying to do. That being said, after the roll call, my favorite segment of the week, it's you know what that is, GC?
I think I have an idea.
Yeah, it's the one Madison shares good news. What's the good news, Madison?
All right, everybody. The good news today is that it is Pablo's birthday.
Look at this.
Oh, man. Look at that.
They brought us. Here we go. Hey, okay.
There we go.
Come here. We got Kate in here. We got Cody in here.
All right. Here we go.
All right.
Happy birthday, brother.
Thanks, man.
You look so good right now, by the way.
Okay. Well, this is going to make terrible podcast audio, but I think it's pretty good for the video. All right, Madison, is that what you have?
Yep, that's all I
Technically, Madison, that's good news. I appreciate it. Thank you, Madison. Thank you, Cody. Thank you, Kate. Thank you, Greg.
Man,
whatever you guys have been planning this whole time. Behind my back, you know that I'm uncomfortable about.
Yeah, we love you, man. Happy birthday. Happy birthday.
Happy to be here. 43. I'm 43 years old. So.
43 never looks so good.
It looks so good. It's all about the stash over here. Okay. Well, that being said, I guess we can now transition. Any breaking news, GC?
I think this whole presentation today and this whole conversation we're going to have I think this is really a timely topic. You guys have been asking about rents. You ask about rents often, and I love that you ask about rents because at the core of this investment is how strong are rents, how consistent are rents. That's what separates this asset class from others. And at the same time, people are worried about tough economic times now and in the future.
Yeah.
And so this is going to be a great opportunity for us to combine both of those things, bring a whole lot of data and a whole lot of perspective. That's why I was burning the midnight oil last night, because that's what happens when I get that fired up about some of this stuff, to take a whole lot of data, hopefully make it easy to digest and leave with some really great conclusions for everybody.
Yeah. And once again, this is one of those topics where we have heard you loud and clear. The community talks about it, right? Like, we have all this data of the real estate cycle. It's kind of easy to find the home prices and the things that are happening. If you look far enough, you got to know where to look for this rent stuff. And I think it's definitely advantageous that JWB has the flywheel and everything that you guys have as far as data goes, but you go a step deeper and layer that on with market data, which is what you've gotten really, really good at doing. I think I've kind of seen you blossom and coming up with your own like market data analysis here on the show. So I'm excited. I loved it when I got a 12:30 text from you last night. You were the first person to wish me happy birthday, and I'm pumped to get into this. When you first sent this to me, GC, I think the first thing that came to mind is what you talk about a lot when we're talking about the 5 profit centers. You talk about cash flow being risk mitigation. You want to tell me a little bit about that?
Yeah, absolutely. I mean, cash flow at the end of the day is what mitigates your risk. If you define risk as being cash flow or in being speculative, that's kind of what I equate it to, right? There are investments out there that you can make a big return on, but a lot of times you have to put a whole lot of money out there for a whole long time, and you have to wait a long time to get that money back. And that inherently just creates risk. So when you have an asset that you can pay for itself every single month, that mitigates that risk. That allows you to scale, that allows you to take more bets on this asset class because it pays for itself. And that's really where I want to be. I would think that's where most of you want to be. It is nice to have something that does not cost you money every single month. Now, the only way that we feel confident about making that assertion about this asset class is rents. Are rents consistent? Are rents consistent in good times? And our rent's consistent in bad times. And so I think a lot of people don't really understand that. They don't really understand what rents have done in tough economic times or over decades and decades and decades. And I think when we look at some of this data, it's going to give you a lot of confidence. Even if we do go into tough economic times, that your money that is in rental properties is in a position of strength based on historical data and what we would expect to happen in the future.
Yeah. And for me, when we're going to go over these numbers that you sent me yesterday, I think of the idea of like experience and stability and consistency, right? Like if you are able to get that, if we can show that rents continue to do well, even if prices go down, right? Like we've seen once in the last, 60, 70 years, prices going down in real estate. And we praise real estate for the fact that generally prices don't go down, right? But even then, if we can look at prices and look at cash flow and see that cash flow performs well, even as prices go dip in an asset class, then what that tells me is going into uncertain times, where is the place that when everybody else is kind of freaking out, I can be freaking out less / feeling pretty good about myself, right? Like we keep talking about this idea of moving from this prosperous outlook that we've all been in for 14 years in a bear market to like a new normal of like what's really, really going to happen. And as a guy that values my sleep, I find great solace in this idea of finding something where I can rest a little bit easier and enjoy the experience a little bit more.
Absolutely. And if you're thinking, what is more important to me if we are going into economic times that are tough? What is more important to me? Is it short-term price increases or decreases, or short-term rent increases or decreases? In this asset class, it's about rents, right? It's about rents. And so when you have confidence that rents are going to perform a certain way and that they're consistent and that they don't go down, which is what we're going to talk about here, spoiler alert, that is the basis of this asset class. Saying it another way, if the data on rents was not so strong and so positive, this would not be the risk mitigated asset class that it is. So I wish everybody who is focusing so much and all the headlines so much on when's this next real estate crash going to be on prices, I wish they would talk about rents. Yeah. And if they did talk about rents and they looked at data like we're going to look at here, they would not be talking about a crash in rents. They would not be talking about rents going down because, as the data is going to show here, that just don't happen.
Okay, well, let's get into it, GC. I love it. So, all right, here we got a comparison of Jacksonville, Florida rents versus home prices spanning from 1985 to 2012. We got it separated from 85 to 94, from 99 to 2004, from 2000, right? Every 10 years.
Mm-hmm.
And what we see is from 85 to 94, rent price appreciation went up 3.8%. Home price appreciation went up 2.4%.
Mm-hmm.
During 95 to 2004, 3.1% of rent price appreciation, home price appreciation of 6.9%. From 2005 to 2014, which is an interesting period there to look at, rent price appreciation went up 2.6%, and home price appreciation went up 0.4%. Then the next 10 years, rent price appreciation went 6.2, home price appreciation went 11.1%, with a total of, if you look at the whole market cycle, right, like what we like to talk about here, 40, I guess these are two market cycles, right? 40 years from 85 to 2022, it is an average of 3.6% rent price appreciation and an average home price appreciation of 4.9%. Tell me more about this data, GC.
A couple things. Number one, those are average appreciation rates for both rent and price per year. So overall, from 1985 to 2022, rents went up 3.6% per year in Jacksonville, and overall home prices went up 4.9% per year. The thing that should jump out to you here is, do you see any negatives there?
Not in rent price appreciation or home price appreciation.
Or home price appreciation.
True.
Did we talk a lot about how the real estate crash and the Great Recession and all that good stuff? Well, if you go out 10 years, which is what these segments of time are, this is why I preach this over and over and over again. You win when you hold on for a full market cycle in real estate. It's because if you go back almost 40 years here, there have been no 10-year segments of time, or at least these 10-year segments of time, where you've seen a decrease in housing prices. And I chose the toughest ones to highlight there. I chose 2005 to 2014, which would be called the toughest cycle, 10-year cycle there. That should jump out to you. It is so infrequent that home prices would go down, and so infrequent that rent prices would go down. And so if the big thing is overall you win with the big market cycle. And I think the other thing that jumps out here is, more often than not, you're going to be somewhere right around that long-term average, right? We had the average here of 1985 to 2022. That's a 3.6% rent price appreciation per year. Well, most of these years are somewhere right around there, except for the last, call it 8 years, you had 6.2%. And so in home price appreciation, right, you're typically not very far off. However, the last 2 10-year cycles-ish have had very large abnormalities, and that's why they are farther off. But even with those abnormalities, they are not negative. This asset class is consistent. This is risk mitigation, what you're seeing by the numbers here.
Yeah. And I like that these are 10-year lookouts, right? Because that's generally what we talk about when we are calculating IRRs, either in properties of the week or portfolios of the week or whatever. And it really does shine a light on this idea that even in the worst period, it performed well, right? Like it did well. You didn't lose money. It preserved capital, right? Like this idea that when we go into these tough economic times, we look to preserve capital, increase cash flow. I look at the hardest economic time, 2005 to 2014, and guess what happened? Capital was preserved. There wasn't a loss in prices, and cash flow was increased because there was an increase in rental prices. Right?
Absolutely. So absolutely.
In line with stuff that you've been saying for a long time, which I love the data showing. Okay, cool. So let's go a little bit deeper here then, GC. You want to talk about these different periods?
So that was just kind of like big picture, some of the data behind why it makes sense to buy and hold and risk mitigation. But now let's jump into specific points in time where people have labeled it as, call it the worst buying decision that you could have made. I remember when I started to invest in 2006 and 2007, and then the Great Recession happened, people looked at me with pity. They thought that I had run into the worst stretch of luck, that I picked the worst investment of all time. And I remember looking at them and I'm just thinking, I don't really feel that, like it's not really that bad. I didn't need to sell it at that moment. And I remember rents coming in consistently and rents going up. So I went and I pulled back that data. And so from 2007 to 2011, which many have labeled the worst time to buy a house in the history, in our recent history, we had the Great Recession, we had a housing crash. Rents still went up 2.8% per year in Jacksonville. If we had polled the audience before this, how much did rents go up during the Great Recession?
Yeah.
I pretty much would bet nobody would say close to 3% per year.
Agreed. What do you think is the reason why rents were going up? Like, am I right in assuming that just like in the other Florida towns of where the Great Recession hit really hard on home prices, there was a bunch of people buying homes that couldn't buy home, that shouldn't be buying homes, right? Like they shouldn't have qualified for these mortgages. They were too risky. And was there also a population decline? Talk to me, like when you look at this, like what is happening in the market that allows for rents to continue to go up even though home prices are going down?
Population continued to go up and jobs were here.
Okay. So even when there was a giant recession where a bunch of people lost their jobs, there was still enough jobs in Jacksonville that people wanted to move here, and therefore the supply of rental properties available to them were lower than the demand. Yeah. So rents kept going up.
When the Great Recession happened, people stopped building houses. So the supply of homes was less, right? You needed less demand in theory to support the supply, right? Because rent prices are just supply and demand, just like home prices are just supply and demand. So I'm sure there's an element of that. But the biggest thing is, and this is why it's so important to pick the right market, you have to pick a market that has a diverse and strong economic foundation, right? In Jacksonville, we have 3 Fortune 500 companies. We have 4 Fortune 500 companies now. Landstar is our 4th. I've been saying 3 for so long. So it's 4 Fortune 500 companies that are here, as well as a number of major employers here.
Can you name the 4 Fortune 500?
FIS, Fidelity National Financial, CSX, and Landstar.
Isn't there a second Fidelity that's a Fortune 500 that's in there? Isn't it 5? Like, isn't Fidelity and Fidelity National Services 2 different Fortune 500 companies?
Well, yeah. But didn't that get us to 4?
That would make us 5, right?
Fidelity Financial.
Yeah. Fidelity regular. Fidelity National.
There's FIS and then there's FNF.
Okay.
And one of those is Fidelity National, which I think is FNF. And then there's FIS, which we all know and love here in downtown Jacksonville, fintech, and we've had their CEO on the show. So that's 2.
Okay.
And then there's CSX, which is commercial railways. And then there's Landstar, which is the newest addition to the bunch.
Cool. Well, I thought that we were going to give that other segment that we had as the worst podcast segment in history a run for their money. We got it right. All right, continue.
So that's what it comes down to. Yeah. You need to make sure you choose the right market that has a strong, diverse economic stability to it. And we need to make sure that population is growing. And that's how you mitigate the risk of rents going down and home prices going down.
Yep, that makes sense. Okay. So then this is the Great Recession caused by housing. Housing crashed. Home price appreciation went down the most it's ever gone down right, in a short amount of time. Rent prices still went up. What's the next period here?
So then I coined this from 2012 to 2019, the age of easy money, right? Interest rates were incredibly low for a prolonged period of time, for that whole period of time, and actually even longer than 2019. And when that happened, along with the fact that we have been chronically undersupplied from a housing perspective, we saw home price appreciation percentage gains that were higher than normal through that time period there of roughly 8 years. So home prices then went up 6.8% on average per year from 2012 to 2019 in Jacksonville, and rents stayed consistent. They went up 3% per year in Jacksonville. So this theme of consistency and positive gains for rent price appreciation continues to happen. That's why home prices and rent prices are not correlated. And that's, of course, what we saw from these 2 time periods.
Got it. So toughest times ever, rents still go up while prices go down. Good times, like, right, everybody's looking at this. These were prosperous time, age of easy money. Rent price stays good. Home price goes way up, right? So we're seeing a theme here. Bob Wiesner has a question. How does that 2.8% rent price increase in Jacksonville during the housing crash compared to national rent stats during the same period? Do you have any insight on that?
You know, I looked it up yesterday. I was actually thinking of adding that onto the slide. I don't know the exact percentage, but it's close. It was right there. So I decided not to put it on the slide because I didn't think it was noteworthy, but it was really close to what the national rents were. Okay.
So nationally, the average of national markets in the United States would still be somewhere around 2.5, 2.8, 3%.
Yeah.
That went up during the Great Recession.
Yeah.
Okay.
Yeah. National rents have never gone down.
Yeah.
In the history of tracking this goes back to 1985, which is when the good data started to actually be populated nationally. National rents have never gone down.
So if somebody is hearing a statistic about like how rents went down during the Great Recession, it has to have been like a local market kind of data point?
Could be a local market, could be the time period, right? So like there's seasonality when it comes to rents every single year. You know, like one of the things we've talked a lot about on the show is if you're talking about home prices month to month, or even rent prices month to month, you might show a decline. And the reason is because that's how people think and make buying decisions. That's how the weather patterns are. And that's when people want to get out and look for houses versus when they don't. When you go into the end of the year and it's cold out and your kids are in school and you don't want to uproot them, there is less buying demand in, call it July through January than there is from January to June. And so what you see is every year you see price declines month over month. It's called seasonality. It happens every single year. We've highlighted that on the show multiple times. So part of this is like the period of time. If you said, have rents ever gone down month to month in Jacksonville or in some other place? Yeah, I could probably pull that data where Jacksonville rents have gone down from one month to the next, but probably a lot of that is seasonality driven because every year there is seasonality. And then rents or home prices go down at a certain time of the year. And guess what? When it's spring and then it's summer and it's house buying and house renting season and tax return dollars come back in for folks, then they go out and they buy more and they rent more. And then you see more gains than outweigh the losses that or the declines that happen at the end of the year. And then at the end of overall year over year, they go up. And so when I say overall rents have never gone down nationally year over year, that's what I'm talking about. The seasonality, you get that taken out. You look at one point in the year to the next point in the next year, removes the seasonality, and rents have never gone down nationally.
Got it. So data with perspective, right? Like we've talked about this in the past on the show. If you're looking month to month and you can extrapolate these different things, it's just not the right way to look at it.
Yeah.
Because that happens. You got to look at things year over year, and things really you really start to see the trends that you can count on when you start extending the timeline, right? Like these are periods that you're looking at that are like 4 years, 7 years. Slide before was 10 years. That starts normalizing even more. 20 years, you can pretty much count on it being a full market cycle. Over 40 years now, you can really kind of like see this idea of like a recurring pattern as well.
Yes.
All right, GC.
Yes.
So then the next era that you coined here is what?
2020 to 2022, we'll call it the COVID pandemic and high inflation era. And during this era, we first started again with an extreme amount of fear in all investments, and real estate was targeted as one that people did not want to invest in at the very beginning. People were calling for the crash. And for those who had not been through this before and weren't looking at the right data with perspective, the fact that we had an eviction moratorium and a foreclosure moratorium would lead people to believe that a crash was coming. We never said that on the show because we were looking at other data that was far more impactful. And we were right? So when you look at rents from 2020 to 2022 in Jacksonville, they went up almost 9% per year on average. And home prices went up 16% per year on average during that time.
Okay. Yeah. So this was you didn't see coming just like market explosion, essentially, right? Like 2020 to 2022, everybody was afraid of something that was happening and they were looking one way, and the market actually did something very, very different than what was originally expected. And kind of, I mean, if you look at this period, would you say that this is the highest performing period for the market in the last like 40 years?
Yes.
Yeah. Just based on a confluence of things, right? Like it started happening because I think a bunch of trends kind of like coincided, right? This idea of remote work was happening. Regulation wise, Florida was doing certain things that made living through COVID for those that weren't afraid to stay healthy or whatnot, to just have a higher quality of lifestyle. And that brought a whole bunch of people down. The disconnecting to the office, right? The idea that we're all going to be zooming in, a lot of people to work from anywhere. So people move to a nice weather, no state income tax, state. Anything else that I'm thinking about that happened there?
Oh yeah, the Fed.
The Fed.
The Fed kept interest rates at zero for this entire time period. And not only did they do that, but they became an active participant in the economy by buying bonds and buying mortgage-backed securities. And all that's a little bit of mumbo jumbo for a lot of folks. But at the end of the day, what that does is it artificially lowers your long-term interest rates for buying real estate and other things as well. And so that's why we had interest rates being, even in the twos at some time, 3%. It was artificial. And so what that did is it brought demand forward. The other thing to keep in mind is that supply was incredibly low as well. So, but if you look at those 3 time periods, Pops, are we still showing that?
No, I'll show it right now.
Okay. Let's look at those 3 time periods because I chose these. Well, I chose them because I wanted to choose different points in time where people were making different decisions. But here's the conclusion that I sort of land on when it comes to rents, prices, consistency, risk mitigation for this asset class. When you think of tough economic times, we experienced that from 2007 to 2011, right? The Great Recession, the housing crash. When you think about why this asset class wins in tough economic times, it's because when times are bad, rents still are good. When times are bad, rents still are good. So that means that there's still positive cash flow. It's still paying for itself along with the other profit centers, right? Like principal pay down, tax savings, right? These things are not dependent on whether or not the economy is good. So you have these profit centers along with cash flow that still come in even in tough economic times. And it's because of rents. And then you go to the next time period, 2012 to 2019, we'll call it the age of easy money. There was a lot of, that was really kind of the noteworthy thing that I took about that time period, but we'll call it a pretty normal time period. In normal time periods, you win because rents still perform, but home prices go up. It is so rare for home prices to go down that when things are normal, you win because home prices go up and rents go up. But then when you have a confluence of things like,
free money in the system.
Yeah, right. Low interest rates, the Fed being an active participant in the economy by buying bonds.
About this being the best asset class.
Yes, absolutely. Right. Yeah. And then low supply, you really win. And this is because this is such a critical need that this is kind of like these 3 time periods to me mean high floor with high upside. And that's what I love about this asset class. High floor with high upsides because of rents, and home prices generally go up. And when they go up, as we've seen, they can go up a whole lot.
Yeah. So if I can say what you're saying essentially in 3 sentences, which I think is the big takeaway of this data, that's where my head was going as I was looking at this too, right? It is when times are tough, then the fact that prices may stabilize, not go up much, even go down much, rent keeps the investment stable and it keeps the short-term experience good. It allows you to hold on to it without experiencing a lot of pain and therefore drives the floor up. Like the worst case scenario is made better by the fact that rents continue to go up in tough times. When times are good, then rents are still going up. They're still doing their thing. They're still providing that high floor and prices are going up. So when times are good, both of them work together to like supercharge it, which is why you call this thing a high floor, high upside investment. When times are tough, there's a floor there. And when times are good, these things work in concert to supercharge it along with that.
And what other investments produce that? It's a good question. What other investments out there that you are putting your money in produce that type of high floor and high upside environment?
Yeah. Low risk, high reward is not something that you often hear.
Right. Yeah. Yeah, exactly.
That's another way to put it. Low risk, high reward, high floor, high upside. So this is at the end of the day, the full market cycle.
Yeah.
Right.
From 2007 to 2022. Again, if you go back and you were Gregg in 2007, people were, giving you pity because you bought rental properties at that time. Well, I've owned those. And so I have the data through 2022. Overall, guess what? Rents went up 4% per year, and home prices went up 3.8% per year, which is pretty darn close to the overall averages from 1982 all the way through 2022. So this is some more data to further the point that we make often on the show here, is that short-term pricing is the least most important thing. And that if you hold on for a full market cycle, we already know the answers to the test. I don't care what you throw at us. At the end of the day, you're going to see, call it somewhere around 3.5%, 4% rent price appreciation per year. You're going to see somewhere around 4.5% home price appreciation. And that's why we love continuing to invest and scaling up in this asset class, because there are so many knowns here in an investing environment with a lot of unknowns.
Love it, man. Let's hit some of these questions right here. Ready?
Love it.
Ride along. Raj Bantu's got a question in here. Actually, you know what? Our patron Centaurus had our first one. Michael Centaurus asked, Greg, what impact do you think the recent news about the Federal Reserve leaving interest rates unchanged will have on rental rates in Jacksonville and home prices?
I don't really see that's going to change rents and home prices in Jacksonville today, right? I think if the Fed was going to lower interest rates, I think the minute that the Fed lowers interest rates somewhat of a substantial nature, I think you're going to see home prices go up, because whereas in 2020 and 2021, when interest rates were held artificially low from those activities, it brought demand forward, which led to increased home prices at an above average rate. What we're doing right now with long-term borrowing rates being, call it close to 7.5%, 8%, by the way, JWB clients, it's less than that, but just for the general population, what that's doing is suppressing demand. It's suppressing demand. So the minute that you start to bring some of those interest rates down for long-term borrowing rates, I think you're going to see the market act more in accordance with what it would do if normal rates were here. Mm-hmm. And right now we are undersupplied for the area. Mm-hmm. We don't have enough supply to meet the demand. So to answer the patron Centaurios' question here, I don't think that there's going to be much that changes based on the Fed leaving them the same. Yep. We are all preparing for a high interest rate environment, call it coming for the next 12 months-ish, and that will artificially suppress demand. And when they come down, I think you'll see home prices go up pretty dramatically.
Would you say, GC, that as long as it's not going to dramatically increase, right? Let's say rates aren't going to continue to go up at a crazy rate, mm-hmm. but they stay around this level and they're not going to go down for a while. Would you say that that's baked into the economy at this point? Like, are people kind of like, if we're just going to hold on to this rate for like a year, kind of like what you just said, would you think that it's just baked in and it's kind of be business as usual? It's not going to be particularly prosperous time, but it's also not going to be like anything crazy. Is this high interest rate environment not really changing for a while? Do you think that it's baked into the ecosystem?
My simple answer would be no, I don't. I think that it is unrealistic to think that the economy is going to continue to operate this way with this high of interest rates for an extended period of time. I think something has to break in the economy. And when we say break in the economy, what that means is that inflation comes down, there's less money to spend in the economy, and GDP comes down. So these, while we may or may not lead to a recession, something has to give at some point is what most people feel. And that's how I feel about the economy. The only thing that really kind of makes sense to me is that over the last month, I feel like the country and the stock market and, other markets, they finally believe, and I think business owners too, right? I think they finally believe the Fed as to what they were saying, that they are going to hold interest rates, not just raise them to this level, but that they're going to hold them for an extended period of time. And if you go back and look 2-3 months ago and you started to see, they always kind of like, really smart economic people out there always give their prediction for what the Fed is going to do 3 months from now or 6 months from now or 12 months from now. And everybody 3 months ago was saying they didn't expect rates to be this high, and they expected rates a year from that point to be lower. And you've started to see big swings now. People have finally landed and understood what the Fed has been saying they're going to do for a long time. And this is just a theory, guys. You just asked. So I don't have any data to share. This is the only thing that makes sense to me, is that now people and businesses finally believe what the Fed is doing. And if that is true, then they're going to start to make different decisions over the next 6 months than they made the previous 6 months. And that's why, I do think it is likely that we do end in a recession.
Yep.
And it's because at some point, like, the music has to stop. This type of interest cost to the economy and borrowing costs and to people is unsustainable. And I think what it will lead to is tough economic times, which again is why it's great to shine a light on this investment that performs so well in tough economic times when others don't.
Makes perfect sense, man. Great explanation. Just going to throw it out there. Jen and Renee are checking in from their cruise on the Amalfi Coast in Italy right now. Thank you, Jen and Renee. Renee, who is known as the Filipino Clark Kent. I don't know if you realize this on Facebook. That's starting to take on a life of its own. But thank you for checking in, Jen and Renee. I appreciate you.
Enjoy your time, guys.
Being on vacation and
thanks for checking in, guys.
Yeah, it's awesome. All right. So right along Raj has a question. 10-year Treasury yield is coming down in the last few days. And when Fed ends interest rate hikes, risk premium comes down even before Fed lowers interest rates. That will result in even lower mortgage rates as compared to today's mortgage rates.
I hope you're right, Raj. So what Raj is kind of highlighting here is the difference between what the Fed funds rate is, which is that affects short-term borrowing rates. Mm-hmm. The Fed basically sets the baseline that banks have to borrow from, and then all of your other short-term borrowing rates are basically built off of that. And the 10-year Treasury is something that is highly linked to the Fed funds rate. So the 10-year Treasury is linked to that. But that's not exactly directly correlated to long-term interest rates. It's indirectly correlated. And what Raj is highlighting there is that there's a premium that investors require to invest in mortgage-backed securities. And mortgage-backed securities are that's what our mortgages are. Mm-hmm. There's an investor on the other side who's earning that 6% interest rate. And so it's a combination of these things. So some ways that the rates could come down, the Fed could lower the rate. That would have an indirect effect because that would bring down other similar investments like the 10-year Treasury. And then the mortgage premium that investors require over the 10-year Treasury could also come down. And so the premium right now over the 10-year Treasury is way high. It's higher than it normally is. And so I would love to get that back down to normal. It's normally about 1.7% over what the 10-year Treasury is. Mm-hmm. And, 10-year Treasuries are they're probably about 4.5% right now, or 4.5 to 5, somewhere around there. So if you were going 1.7% above, 4.5, you'd be at, call it 6.5% interest rates. But for the general public out there, it's about 8%. So the spread, the premium is still way high. And so I hope that comes down. That would be nice.
That would be nice, man. I guess it's maybe a glimmer of light at the end of the tunnel that there's this opportunity for this thing to happen. Sounds like what you're saying is it feels like the Fed has sent a clear message. These high rates are here to stay. It sounds like that might take us into some recessionary, into a recession for at least a certain amount of time. There's going to be pain in the economy. What we're showing is that there is going to be pain in the economy, and yet in the single-family workforce housing rental property market of Jacksonville, Florida, that pain gets mitigated for investors, mm-hmm. if that's where you're putting your money. And also the other thing that you've kind of mentioned is this idea that when rates do come down, then at that point it's going to go crazy, right? So things are gonna shoot up the moment that rates come down, because there's going to be all this like money on the sidelines at the moment that it blips, get out, which to me says, okay, if I'm making an investment decision, I'm thinking hard economic times ahead, there are signs for it, right? Like whether my Waze is going to like navigate me through them or around them or not, there are signs for it out there. And therefore, what I want to make decisions based on is like calculating that it may happen. So I want to mitigate risk. I want to, put things in safe places, mm-hmm. and I want to put those things in safe places, in a safe place that's going to be safe in the short term and then has exposure to the upside the moment that it gets better. Yeah. Which is when rates do come down, having your money in this thing is going to perform well as well.
Mm-hmm. Yeah. Okay, cool. I, in the course of our conversations a couple of days ago, and then as I was putting this data together, I was like, I need to go and research the last time that the Fed drop their Fed funds rate, call it like a point or something along those lines, like a substantial drop, which is what we would expect at some point, call it over the next 1 to maybe 2 years, we expect the Fed to drop, their interest, the Fed funds rate. What was the effect on housing prices after that? So we just thought of that. Stay tuned. I'll get that data. We'll share it here on a show. But I think that's the real opportunity here that all of you have to increase your portfolio of rental properties before that happens. And I'm excited to see that happen and to report on that, because I think it's one of those opportunities that people just don't see.
Cool. And by the way, if you want to do that, you want to get into a risk mitigated asset, you want to get in before the rates come down and the party starts really getting going, so you get a really good seat at the party, go to chatwithjwb.com. You start looking at what it takes to get into this, right? It's a process. So you want to identify where you're going to get your capital from, really understand it. It's a very, very slow process. So you want to go to chatwithjwb.com and start getting that going if this is something that interests you. Let's jam 3 more questions, GC, and then I think you got another kind of like point that we want to illustrate.
Yeah.
Ken Moline asks, Greg, do you have any comparative data for annual rent increases versus annual property tax increases?
Yeah, I mean, we expect property tax increases to go up about 3% per year, and then rents go up about 3.6% per year. But those numbers aren't the same, right? Your rents each year, right? If it's, $1,500 a month of rent, that's $18,000 a year. That would go up 3.6% for the year. Your property taxes might be somewhere around $2,000 a year or $3,000 a year. So you win 3.6% on a bigger number, far outpaces 3% property taxes on a smaller number. And that's one of the reasons why cash flows grow over time.
All right, great take, buddy. Pedro Nacenciano from Jersey says, with the rapid interest rate increase, did that have any impact on the Jack's population immigration?
Just growing, baby. Keeps growing.
Yeah, because if all else equal, Jacksonville is still underpriced, right? It's still below the national average, still has better weather than just about everywhere else in the country, still has a super high quality of life, and people are moving here, man.
Yep.
I don't blame them. Also downtown coming online, going to be awesome.
100%.
All right. Denny Davis has an interesting take here. Greg and Pobs. I love the Pobs nickname. Thank you, Denny. You guys talk about home price increases being a big part of the Pac-Man pie chart. This idea that when the distribution of where your wealth comes from, the Pac-Man is home price appreciation. All the others are the mouth of the Pac-Man, right? Yep. That's what Denny is saying. However, would you also say consistent rents are the backbone of the Pac-Man that gives an investor the confidence to move into this asset class for the long term? Cash flow from steady rents may not be what makes us rich, but it plays an outsized psychological role from my perspective.
I love that take right there. Cash flow gives you the confidence to get into this asset class. I love that. Yeah. It's not something we've said or vocalized on the show, Denny, but I really love that. And it's not the most important thing as far as your overall return on investment. But if that's what gets you in the game, then that is the most important thing. Yeah. Right. And yeah, I agree with you. I just think that it's not a simple narrative on like what's best here. Right. That's why we have all 5 profit centers and we love them for different reasons. Yeah. They're like 5 kids. Like, how could you choose between your 5 kids? Right.
Yeah. And I would use a different part of the body than the backbone of it. Right. Because if the Pac-Man is going to grow over time, right? Because of home price appreciation. And the thing that keeps you in there having a short-term good experience is the cash flow, right? Because it's mitigating for all the other stuff. Maybe it's the teeth of the Pac-Man, right? It allows the Pac-Man to chomp and continue to grow because you have that positive cash flow and you're in that scenario. I don't know, work in progress. That being said, you got something that really illustrates this idea of cash flow. And this is what we want to talk about, right?
Yeah. So I always love to bring it back to, Greg and 2007 and some of the decisions that I made. And I still own all of these properties here today. So I think it's a great teaching tool. So I went to this property here at 1123 Scotton Road, still own it today, bought it back in 2007. And I wanted to illustrate what I have lived through during the Great Recession and the housing crash that followed. And why, when I look back at that time, when everybody was telling me it was a terrible decision, I didn't understand it, because in my own head and in my own bank account, I saw rents continuing to come in and rents growing. So 2007, Scotton Road, bought the property, rented that out for $1,025 a month. Now at that time, the property value was $155,000. Wouldn't love to buy more $155,000 properties in Jacksonville.
Oh, yeah, that'd be nice.
I was ridiculed for this, by the way. I was ridiculed for buying this. People were laughing at me and I didn't get it. But that was 2007. And the market started to turn soon after that. Fast forward to 2011, still own this property. And look what's happened here, Pobs. Rents went up. Mm-hmm. Rents went up. Mm-hmm. My property value, what did that do?
Looks like it took a dip.
It took a dip. Mm-hmm. Why didn't that matter to me?
Because you were still making money month over month and it wasn't costing you anything.
Yeah. And I had never had the plan to sell in the first 4 years. Mm-hmm. I was committed to buying and holding for a full market cycle, which is what many people already do with money outside of real estate. But for some reason in real estate, they're like, oh, well, I can't commit to buying for 10 years or something. I'm like, you already do that with your money in other places.
Yeah.
So because I did not need to sell in the short run, mm-hmm. and because my rents continued to go up, my homes were occupied because of the strength of the Jacksonville economy, we saw rents going up. We saw home prices going down in 2011. Fast forward to 2023. Again, I still own this home. It is currently rented. It's in my portfolio right now. Rent price is $1,632 and property values now worth $295,000. None of this would have been possible if I didn't invest in this property at a time where everybody says it was the worst possible time to invest. Mm-hmm. So if you are thinking about investing right now and you're concerned about the economy, guess what? I already lived through it. There's data to support what it looks like in the worst case scenario there. It's not bad. It's not bad. I don't know what exactly is going to happen in the economy a year from now. I can't tell you what home prices are going to be 2 years from now, 3 years from now, because you know what? A lot of things can change. But what I do know is that rents have never gone down nationally. Rents didn't even go down during the Great Recession here in Jacksonville. And the chances of rent going down, even if the economy goes into a tough spot, is extremely unlikely based on historical data. So that should give you a lot of confidence that this is an asset class you can invest in even in tough economic times.
You know what I read into this, GC? I look at this idea, you purchased this in 2007. Everybody made fun of you, right? What were they making fun of you about?
I just felt bad for me. I was a young kid. I put all of my time, energy, and talents and what little money I had into a real estate business. And they were like, man, you got a raw deal.
Yeah. Yeah. They're probably saying top of the market. They're probably saying this isn't going to do well. We're in a bubble or something like that.
Oh, yeah.
Right. But if wherever they would have put their money in 2007, I'm pretty sure it would have gone for a real roller coaster ride too. Mm-hmm. You fast forward to 2011, you're still positive cash flow on it. Property value is down. If you would have bought it then, do you think they would have made fun of you?
Yes.
Yeah. What would they have been saying then?
Real estate's in the tank. Why would you invest in real estate? There's no way that it's going to go up in value. Mm-hmm. There's no way that rents are going to continue to go up. They would have looked at foreclosure percentages and said, how could this possibly be happening? So that's what they would have said.
Yeah. And then it would have been the time of easy money. Then it would have gotten to 2020. And wherever this was, if you would have bought in 2020, they would have made fun of you.
They would have. Yes. They would have been, listen, in 2020, we're talking about now. Yeah. Oh, yeah. Well, how could you invest? There's an eviction moratorium. There's a foreclosure moratorium. That's going to pop. That's going to be the next housing crash. Mm-hmm. They would have said that. They would have made fun of me.
And now 2023, they're probably making fun of you right now.
Yeah. How could you possibly think about buying real estate when interest rates are 8% out there for the general public? How can you do that? Why do you think that that's a good place to put your money? All the same stuff. I hear it every single year. You name the reason.
Wait a year or two. Wait a year or two. That's what you should probably do. But at the end of the day, purchasing in 2007 was the right decision because we've talked about how this has performed at like a 17%. IRR, ROI, I don't know which one it is. 2011, it would have been a great purchase because you would have got it right in the beginning of this like age of prosperity. 2020 would have been incredible because you would have gotten all this like home price appreciation and rent appreciation. So this idea that this isn't the right time to buy because XYZ is like the oldest trope, right? Like it's the oldest kind of like everybody continues to do it. There isn't a time where someone's going to be like, you know what? Yeah, man, you're right. This is the time to buy. Smart. You are so smart.
Yeah.
So I just think it's a natural thing to bring up, right? Like we've talked about this a lot over the last 3 years, and it's the first time that we're really starting to talk about this idea that we can talk about the numbers and talk about all the stuff that all we want and show how well all these things have performed. But at the end of the day, the feeling is always going to be like, I don't know, maybe I should do this. Mm-hmm. And the result ends up being the number, which we continue to show. So, if you're thinking about it on the sidelines, you're like, we're headed for tough economic times. I want to plan for retirement. I might be too old, this and that, blah, 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 blah. what we have continued to show on the show, and specifically today with these numbers, is this idea that this is a high floor, high return investment. If you think tough times are coming in here means that you're going to, like preserve capital and probably do better than other places where that could be. Mm-hmm. If you think good times are coming, then you're going to outperform that in most investments, because when good times happen, real estate goes up as well, rents go up as well, and all this stuff happens, right? So I just think that that's the thing. Like the feeling of uncomfortableness that we're feeling right now is no different than the feeling of uncomfortableness when it was the best time in history to invest in real estate. And that's why we continue to talk about chatwithjwb.com, because you get to talk to an expert that gets to kind of like, calm the emotions, talk you through it, show you what it's going to look like. So if you're thinking about it, go there.
How cool is it to talk with a team who has lived through the worst housing market that we probably will experience in our lifetime? Like, how cool is that? I am more of thinking of like, what's the downside to an investment decision? There aren't many investors out there who have owned hundreds of rental properties from 2007 on. So if that's what's holding you back, jump on the phone with my team, go to chatwithjwb.com, talk about it, talk about those fears, because if that's what's holding you back, there's just data. There's experience. We can talk through it. We know what it looks like, and that can help you make a better decision.
I'm glad you finished that without me distracting you.
I didn't know what you were doing.
I didn't know what I was doing. So that makes two of us. All right. That being said, good show, buddy.
Yeah, man.
Good work. Good data. Good explanation of all this stuff. Great questions from the audience, from our community over here. We got a couple of like last minute questions. Raj Bondru asks, what is the current MOI in Jacksonville? Raj, perfect time to bring that up, because on Tuesday, it's what, GC?
It is the real estate market update.
The real estate market
here on next Tuesday. So I will have that data and more for you next Tuesday, Raj.
Here next Tuesday, that data and more. It's our most watched show, most attended show every single quarter, most downloaded on the podcast, most watched on YouTube. So real estate market update, where current JWB clients, community members, et al. Gathers around a screen to watch us do what we do when Gregg brings his real A game. Right now, this was his A game, but he brings his A++ because he knows it's a big deal. Budget. That's happening on Tuesday. Hope to see y'all there. Billy Green, the Mountain Man, says 1123 Scotton Road was put into different title names and or trust. Can you explain the benefits of taking a property out of your personal name and put it into an LLC name or trust? Might be a whole show subject.
Yeah, let's save that one, Mountain Man. There's more to that. A lot of the reasons that it was put into different names is really about financing more than anything, Mountain Man. But we can talk a little bit more about trusts, LLCs, all that good stuff.
Cool. We'll do that in a future topic, because we know that when you ask a question and we make a show out of it, people show up. Michael Santoris asked Gregg, have you seen any changes in lease renewal rates over the last year?
Renewal rates are pretty normal right now. I'd say less than 3.6%, which is the historical average, but they're not decreasing. So, the rate of the decreases has gone down from previous years, which is surprising to some folks. We're not seeing 10% increases per year like we saw last year and the year before. But, normal, call it that flat, call it 3.5%, increase per year is pretty normal.
Got it.
Yeah.
And
we got a little extra something, and I didn't prep you for this, but I did want to take a little minute here, because I wanted to say a special thank you to our community leader over there, our MTM Madison the Magnificent over there. Madison has stepped into this role and has done an incredible job on the show. You all know her. You all love her. She brings such a fire and a passion here and a perspective that I don't have, which I have truly, truly enjoyed. I've asked Madison to jump into a few different places in the business, some big marketing opportunities for her. And it's going to take her away from her time that she's able to spend on the show. Here, she is continuing to be a part of our community, but you're not going to see her bright and shining face on the show going forward. So I just wanted to take a minute and say thank you, Madison. You've done an incredible job. I don't know if anybody truly understands this about Madison, but she is the most fearless person when it comes to taking on new opportunities. It's incredible. From the moment she stepped onto our team, I have been throwing new things at her over and over and over again, and she just always rises to the occasion. So thank you so much for what you've meant for this community. She's not going anywhere. No. Nobody get any concerns. She's not going anywhere. She'll still be here. She'll still be here. So thank you so much.
Of course. Thank you guys. It's been a fun ride for the past year and a half now, a little over. So I'll still be at the meetup when we do it. I'll still be around, but you won't won't get any good news from me. Gregg's going to take that one over every Thursday.
Tough.
Is that what it is, Gregg? You wanted the good news segment for your
I
side?
guess.
It is.
Yeah, I
100%,
guess.
Absolutely.
Typical.
So-
Madison, it's been awesome having you here. I remember like when you first got here, just agreed, fearless, right? Like you take on anything that you are asked and you just go for it. You do it well. I didn't even know if you had good news today. I knew I didn't have to check in with you because you're so reliable. And I think, Gregg, you've taught me this idea that you never get to not have problems anymore. You just get to go solve bigger, better problems.
Higher quality of problems. That's what we're
quality of
always
problems.
looking for.
Yeah, somebody that could do that stuff. So awesome having you here too. And why don't you send us away, Madison? Since this is your last time here as on-camera community, what do you were the originator of this.
I was. It was actually like one of my first recommendations in the marketing meeting. I got hired and we were talking about the show and they were like, what's something we could do in the show? I was like, you need like a catchphrase. And that was the first time I talked and they all looked at me like I was crazy. Like, why is she talking? She's just got here. But I was like, you guys need a catchphrase. So we ask you to do one thing at the end of the show. And that is don't be
average.
See you on Tuesday.
See ya.